Canada is living through one of the biggest and most dangerous housing crises ever, and economic experts foresee an even darker future for Canadian homeowners. The year 2023 is about to hit a dead end in Canada's housing sector. As the central bank grapples with rising bond yields and Fed hikes, mortgage rates in the country have skyrocketed. For a country that will host a new generation of immigrants in the middle of a housing shortage, that's bad news, and there's no way out. In this video, we are going to break down how the high bond yields impact Canadian homeowners, why the central bank is going to cause high rentals, why investors are adding on to the problem. Before we start, make sure to subscribe to our channels for more informative videos. Let's get started. Canada has a bit of a problem, despite experts' high alert warnings. Bond yields have been rising sharply since July 2023. Now, that's bad news for investors altogether, but one of the biggest impacts of rising bond yields is on the fixed mortgage rates that will keep showing an upward trend. This is to say that for a common man, housing their family is going to become a far-fetched dream if the bond yields keep rising. In September 2023, Canada's fixed mortgage rates saw a 15-year high, and experts warn us that the Government of Canada's bond will keep yielding in the coming months of the year 2023. We will talk about what is actually causing this particular problem in Canada. But foremost, let's talk about what happens to aspiring homeowners in Canada. First things first, the housing crisis is already suffering as the government keeps yielding its bonds. This is to say that in comparison with other stocks that can earn money for investors, only government bonds look relatively lucrative, since fixed mortgage rates are vulnerable to these sensitive changes in the bond market. Banks and mortgage providers are being forced to increase mortgages as well. This, in particular, is bound to aggravate Canada's housing crisis. To put things in context, you must know what's happening with the property crisis in Canada. The country is running thin on affordable housing, and the existing property projects are either too expensive or delayed. It's not surprising that low-income households, as well as foreign students and immigrants, are on the verge of being homeless. According to a report published by the BBC, Canada needs to build 5.8 million new homes and 2 million rental units by 2023 to even start solving the housing crisis problem. Even then, the larger problem of housing being unaffordable will remain largely unsolved. Ever since 2002, Canada has been living through a property bubble. This means that property prices in the country have been skyrocketing, a problem that will only be aggravated by the rising bond yields. Not to mention, the Bank of Canada has also been increasing rates that result in high variable mortgage rates. So, when you have high fixed and variable mortgage rates, it's hard for aspiring homeowners to keep up with their mortgage payments. You see, this entire phenomenon has a cumulative impact. At the same time, interest costs for mortgage borrowers have increased exponentially. To put it in numbers, the interest rates on borrowed mortgages have skyrocketed by 70% year over year. Official data from the Bank of Canada also reveals the same statistics. Real-time analytics show that Canadian homeowners haven't seen such high mortgage rates since the year 2007. Yet, this pronounced impact on affordability isn't even. Especially the higher-priced markets in Ontario and British Columbia are going to get very hard hits. Of course, this is not to say that cheaper areas won't face the hit. They are going to be smashed as the government bond yields keep increasing. If anything, the monthly payment needed to buy a home has increased by 12% on average. So, a homeowner paying a mortgage in a moderately priced area would need to pay 400 Canadian dollars extra on every monthly payment. Experts believe that indebted households are going to cut their spending exponentially in the upcoming months. The domestic demand in local markets is also going to take a hit. And you thought the Trudeau government was taking the housing crisis seriously. Canadians' troubles are far from over though, mainly because the Bank of Canada is a bit ambiguous on how they're going to address the mortgage crisis. Since July 2023, the Central Bank of Canada has been beating around the bush it is still unclear why the bond yields are seeing unprecedented surges. So far, we don't have access to major economic data or insights from the bank either. To be fair, it is not exactly easy to pinpoint any one problem behind the rising bond yields. Perhaps the big rebalancing by the pension funds and hedge funds is adding to the problem, or it could be a shortage of lending capital by the banks themselves. Regardless, experts are more interested in seeing what the future of bond yields will look like, especially for fixed mortgages. Indeed, experts are looking forward to the Bank of Canada cutting the rate hike. No one is sure when that will happen though. Most experts believe that before the rate cuts, there are going to be 2 more surges in mortgage rates. On the other hand, big banks in Canada believe that the central bank will proceed with cutting rates as the year ends. Usually, the Bank of Canada takes 10 months to make major cuts, but in the meantime, homeowners will continue to struggle. As it stands today, one major problem of the Canadian economy are the Fed hikes that add additional strain on the housing market. Following the video so far? Subscribe to our channel for an easy-to-follow economics breakdown. Alright, we know that Canada's response to increasing its interest rate is in line with the US Federal Reserve. While the two countries are very similar in dealing with their inflation problem, the housing sector in Canada is suffering immensely. In the aftermath of COVID-19, the US as well as Canada saw Fed hikes as one of the most effective ways to counter inflation. The Bank of Canada targeted inflation at 2%, which continued to rise through July 2023 to hit 3.3%. So far, we know that Canadian citizens are still grappling with a surge in prices of common essential items, but the government is planning to give homeowners and renters some relief. According to a report published by Reuters, the Bank of Canada has decided to keep its interest rate steady at 5%, starting from September 6, 2023. The rate is expected to remain steady by the end of March 2024. Now, this seems like forthcoming news, because if the Bank of Canada goes back on its word and increases interest rates, highly indebted households will be considerably worse off. This is to say that we'll see a more upward trend in fixed mortgages, as 20% of Canadian mortgages are due for renewal in 2024. Meanwhile, such threatening statistics will keep any potential home buyers on the sideline. And as the country hits record rates of immigration, the demand for rentals is going to surge as well. Since the country is short on housing, we're expecting to see an increase in rents. Yep, by the looks of it, the housing crisis in Canada is going to get worse in the following year, and it is not easy to come up with a direct solution. The easiest solution for the central bank would be to keep the bond yield in check and decrease the interest rates exponentially. That's easier said than done, right? To be fair, the Canadian government isn't the only one to struggle with high bond yields. If anything, the problem could very much be a spillover effect from the US economy. According to JP Morgan, governments globally are facing high bond yields, including North American nations. In a comprehensive report by Madison Fowler, a global investment strategist, the biggest reason behind such a phenomenon is the overall uncertainty of investors. In Fowler's words, we know that interest rates change over time. To account for that variability, investors tend to require more compensation for locking up their money for a longer time versus a shorter time. For bonds, that means demanding a higher yield for bonds that mature in, say, 10 years, than those that mature in 2 years. Let's make sense of this statement, shall we? As we live in the post-COVID world, investors still feel uncertain about when and where to put their money. This increased uncertainty causes them to demand an even higher yield on long-term bonds. The government has to respond to their needs, especially when they're adding to the investor uncertainty by increasing their debt and loose fiscal policies. So, if we are to define this entire fiasco in clear terms, Canadian fixed mortgages will continue to rise until investors feel confident about a stable economy. In the meantime, the crisis continues. Found this video interesting? Give it a like and make sure to subscribe to our channel.